Most people think investing is about action. They believe it is about finding the next big thing. They think you have to be smarter than everyone else. They chase fast, explosive wins. I am here to tell you something different. The best move in investing is often the quietest one. It is a strategy that feels almost boring. But this simple, unpopular idea beats nearly every other approach over time. It is probably the best financial advice that almost no one ever follows. The secret is not in what you do. It is in what you choose not to do. This is the story of that choice. This core idea can be stated in a single, clear sentence. The most effective way to build wealth is to buy good assets and then do almost nothing for a very long time. It is not about timing the market. It is not about trading on the hot tip you heard from a friend. Not timing the market. This concept is not glamorous or exciting. It will never make for a thrilling headline on a financial news channel. But its truth is unshakable. It relies on the slow, steady, and relentless force of compounding, which works its magic only when you give it the decades it needs to mature and grow. Let us imagine two different paths. On one path, an investor is constantly active. They buy the stock that is soaring. They sell when they hear a bad rumor. They are always searching for an edge, trying to outsmart the entire world. Their portfolio feels like a roller coaster, with thrilling highs and terrifying lows. On the other path, a different investor buys a broad collection of solid businesses, perhaps through a simple, low-cost index fund. Then, they go on with their life. The first investor might have a few great stories to tell. But over many years, the second investor almost always ends up ahead. This is not just a theory. It is a fact proven by decades of data and the wisdom of the world's most successful investors. Warren Buffett, one of the wealthiest people in history, famously said that his favorite holding period is forever. He seeks out wonderful businesses that he can own for a very long time. His mentor, Benjamin Graham, built his entire philosophy on the principles of buying with a margin of safety and maintaining a calm, disciplined temperament. They understood that the market's daily noise is a distraction. The real signal is the slow, steady growth of the underlying economy and the businesses within it. The proof for this simple approach is overwhelming. Consider a simple fact that most people find hard to believe. Numerous studies from respected financial institutions consistently show the vast majority of professional active fund managers fail to outperform a simple, unmanaged market index over long periods. These are highly paid experts with access to incredible resources. They spend all day trying to beat the market. Yet, their frantic activity and high fees often produce results worse than just buying the whole market and holding on. Let's look at a story from recent history. Late 1990s, the dot-com bubble roared. Technology stocks seemed to make people rich overnight. Many ordinary people, seeing neighbors get wealthy, jumped in late. They bought stocks with no real earnings. Hype, the hope of a quick profit. When the bubble burst in 2000, many investments were wiped out. People lost their life savings. Meanwhile, disciplined investors in diversified, low-cost funds weathered the storm. They didn't get rich fast, but they didn't get poor fast either. Their wealth kept its slow upward march. Imagine the market as a giant, powerful river. Some try to paddle furiously against the current. They try to predict every twist and turn. They exhaust themselves and often capsize. The wiser approach: build a sturdy raft. Get in. Let the river carry you downstream. The river is the economy's overall growth. The raft is your diversified portfolio. Your job isn't to out-paddle the river. It's to stay in the raft and not panic when it gets choppy. This is best shown with a simple chart. Imagine returns, average investor versus market. The market line, upward, bumpy. The investor line, noticeably lower. Why? Because the average investor tends to buy high when excitement and greed peak and sell low when fear and panic take over. That gap is the cost of emotion. Buying and holding helps capture the market's full return by removing your own worst enemy, yourself. People consistently make a few key errors that sabotage their own success. The first and most common mistake is chasing performance. We are naturally drawn to things that have done well recently. We see a stock or a fund that has shot up in value, and we feel a powerful urge to buy it, fearing we will miss out on more gains. This is like driving by looking only in the rearview mirror. Past performance is not a reliable guide to future results. More often than not, buying what's already popular and expensive means you're buying at or near the top, setting yourself up for disappointment. A second major mistake is letting emotion drive financial decisions. Both reactions are human, but disastrous for long-term returns. They cause us to systematically buy high and sell low. The third common error is underestimating the destructive power of fees. So, what can you do right now to put this powerful idea into practice? It comes down to 3 simple, actionable steps that anyone can follow. The first step is the most fundamental. Save your money. Set aside a portion of your income each and every month. Automate it so the money moves before you can spend it. Even small, consistent amounts can grow into a fortune over time. The habit of saving is the non-negotiable foundation of wealth. Time is your greatest ally on a consistent stream of savings. Second, choose simplicity. For most people, low-cost, broadly diversified index funds or ETFs. They hold all the stocks in a major index like the S&P 500. This gives you the growth of the economy at incredibly low cost. You are not betting on a single company or manager. You are betting on the ingenuity and progress of business as a whole. Third, and hardest, cultivate patience and stay calm. Once you have your plan, stick with it. When markets drop and friends panic, resist selling. Volatility is the price for higher long-term returns. When markets soar, resist getting greedy. The best course is almost always to do nothing. Maybe review once or twice a year, then let it be. This simple 3-part plan, save consistently, invest in low-cost funds, and stay the course, is all you need. You do not need to read the financial news every day. You do not need to have a strong opinion on interest rates or the global economy. You are replacing the need for prediction with the power of patience. Focus on what you can control: your savings rate, your investment costs, and your own behavior. This is how you win a game that is rigged against those who try too hard. Many people hear this advice and think it is too simple to be effective. They want to believe there is a secret, a faster way to get rich. They may try to time the market's peaks and valleys. Countless people try this. Almost no one succeeds with any consistency. The market is a complex adaptive system, a giant crowd of millions reacting to news, narratives, and moods. Predicting short-term movements is a fool's errand. You cannot control the market. You can control how long you stay invested and how much you pay in fees. Use the power you have. The math behind this quiet approach is undeniable. Imagine a steady 6% per year after inflation. The rule of 72 divided by 6 is 12. Your money doubles in about 12 years. Wait another 12, 4 times your original. In 36 years, 8 times your principal. This is not a promise of a specific return. It illustrates compounding when given one ingredient: uninterrupted time. Quiet long-term success stories exist, but are rarely told. The news ignores the teacher who saved for 40 years in a simple index fund and retired wealthy. That story is too slow, too predictable. Headlines chase stock-picking lottery winners. For every winner, thousands lost trying the same thing. The quiet investor's path is not a lottery ticket. It is slow. It is methodical. It is reliable. Here's the short truth. One rule beats 99% of investors. Ignore the noise. Stop chasing the impossible. Focus on what you can control. And let your money grow quietly while you focus on living a good life. Hard to get excited about, easy and proven in the long game. Start today. Be patient. Your future self will thank you. Buy good assets. Hold for a very long time. Pay very little. Do almost nothing. Stay in the raft. But you will. And share this with someone who needs permission to do less. The slow victory is still a victory.